Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about our stock market investment strategy using really solely using closed-end funds. So the normal disclaimers. This is an unedited video. Who knows what you'll hear in the background as I film these in my house. My cat is currently on the move. And with our lightning storms of today, he's just a wee bit Twitter-pated. Uh, All right, so I am not a financial advisor. I am a financial strategist, all-around strategist, and I don't speak like the herd. Meaning, I'm not hopefully, and I wish people on TV talk like this, but I'm not going to talk like somebody you find on TV. Uh, I'm a down-to-earth guy. I prefer no filter, uh, and chances are I'll cuss on the video. Uh, so I don't speak like the herd. I walk in very limited company, and sometimes I walk alone. Um, and then as for messaging, the messaging remains the same. It's help me help more people. Help me expand these videos or really push out the reach of these videos and help more people so that they hear different advice than the traditional stock market advice. Uh, if you like my content, like the videos. If you like my content, subscribe to the videos. And if you want to interact, then by all means, comment on the videos. If you want to give me feedback on the videos, if you want to tell me what you're investing in or get my take on additional funds, then by all means ask. If it, I don't think I'll show our portfolio today, but if you have questions about our portfolio, if you have questions about the spreadsheet, access, anything, just comment on the video. And those things, so liking the video, subscribing to the channel, and then interacting with the videos helps the YouTube algorithm push the video out to more people who are interested in the same stuff. And the goal is to help more people discover a better way to invest than the traditional shitty stock market advice. So, uh, yeah, and I still owe videos. I owe the recent video reviewing what we invested into and why. I also owe, I still owe the overall closed-end fund strategy video. Um, and I think I owe a deeper explanation or maybe a review of my ongoing hunt for a hosting platform. Uh, but in summary, I think I finally found a place to house things that works well for the system I've created, as well as our additional financial stratagems. And that includes everything between day-to-day overall financial advice, stock market investment, real estate investment, as well as the scholarship. If you haven't watched my videos before, I've created a completely free, no email required, which means you don't get spam email, no email sign up, no email list, no fee, no cost, no membership. So a completely free open access, meaning you see the same thing I see. So let's see, free, completely open access scholarship list of, and I'll be honest that I haven't added to it in quite a few weeks, really since summer hit, but currently of close to 12,000, not 12,000, 1,200 scholarships that range from like you could, you or your student, you or your kid could apply for in middle school all the way into post-bachelorate and master's. So it covers the span of things. Some are technical school based, some are Air Force based, some are firefighter based, some are like any number of things. And between the scholarship source, the scholarship hub, and the information contained therein, as well as how that integrates into our financial strategy, and you can piggyback the stock market into the same thing. But we have a entire 12-step system that I've been looking for a hosting platform for, where I could easily discuss each aspect of the system and how it relates. And I think I finally found that place. So I mean, you can find me on Facebook for the time being. Uh, I have a Navigate Your Finances page that I have not posted to consistently for a while, um, but I still run it. And then I have a scholarship hub. It's just Adapted Perspective Scholarship Hub on Facebook that as soon as I update the list, it automatically updates the list on the site. But my goal is to move that to a different platform that's a better fit for the overall financial strategy system. So uh, if I can get that ooh, light flicker, if I can get that squared away, then I can post a video of that. So as it comes to this week in the stock market, I mean, we're still reading the tea leaves, but at the same time, the tea leaves haven't changed much. Uh, we're getting a better, bigger picture, but it's still trending the same direction. Um, Despite Jay Powell not doing his job to lower rates, because I mean his job is twofold: it's to control inflation, not cause it like he did, and then to control rates based on inflation data, which he's not doing. So, despite him not doing his job, the national mortgage average fell to below 7%, really to almost six and three quarters for the first time in 3 months, which meant refinance applications were up along with the general mortgage applications. Now, six and three quarters is still high. I mean, super high comparatively to where if you refinance during COVID or shortly after, you got anywhere from like a 2 to 4% mortgage rate. I mean, that's super low. Who knows if we'll see those rates again, right? So six and three quarters is significantly higher than 4, 3, and 2%, but it's also lower than where it's been. And if you want to pay down your mortgage, if you really want to, you can buy about 1% in points. So you can bring it down to about 5.7, 5.75. That's still better than where it is. Uh, yeah, so I think we're moving in the right direction in that regards. However, whether it's Powell or it's somebody else at this point, somebody needs to resolve the interest rates because if inflation is going down and the jobs report is strong, then it makes no sense that interest rates are still high outside of the Federal Reserve just grasping for power and trying to control the narrative. And on that, the jobs report numbers are strong, and they're strong even though there are many federal agencies laying off people by the thousands. And that's good news for all. Now, uh, it always stinks to lose a job, but at the same time, from my perspective, and from a lot of other people's perspective, the federal government is bloated, and every taxpayer is paying for those people to have jobs that we don't need. So cutting the bloat means less out of pocket for taxpayers, paying for all of that big government, and then a strong job market, honestly, helps that bureaucratic horde because the majority of those minions aren't going to stay on unemployment or aren't even going to apply for unemployment. They're just going to leave one job and go to a next. Uh, Company wise, NVIDIA keeps its hold of the world's largest company. I believe it's the first company to eclipse the $4 trillion mark. But buying the company outright won't exactly help you from my perspective because the current buy-in is close to 165 a share and you're only getting 10 cents quarterly, which is like really abysmal on overall yield versus you can pick up NVIDIA with a closed-end fund and you get a far better buy-in and you get a monthly dividend. Uh, the end of the week saw it's not even a blip. It's like a change in texture in the concrete road between the market and tariffs. But the end of the week saw this change in texture where the market finished a little bit down because of the herd's fear about trade war and trade fears or tariff fears. But it's not a dip. It's really not even anything. Um, it's almost break even week to week, but it still presents the overall opportunity if you know where to look. So, in events like this, reinforce the teleprompter crew's short term memory, or at least reinforce how short their short term memory is. And it just further amazes me that the herd itself has an even shorter attention span or even shorter memory span. It baffles me. I mean, it really does. Like, I get it's the herd, but it baffles me because I don't. honestly understand how tariffs upend the stock market when the herd should have learned from the first time. But then again, it's the herd and they have a short term memory. It's just they don't get it. And the herd is the herd. They don't lead, they follow. So whatever that teleprompter says, whatever that circle of teleprompter jockeys says, whatever the they ring, the herd follows that bell. So when that bell ringer shouts fear from tariffs, well, the herd hears it and they fear tariffs. So if we look outside the herd, and if we look outside whatever mainstream media crappy show you're watching, or hopefully you're not watching, but whatever the herd's watching, every country uses tariffs. They bring people to the table. They're supposed to bring people to the table to negotiate a better deal. Or, pending country, they stifle trade from the countries you don't want in your market. Like if you jack the tariff so high, people aren't going to want to be in your market. But everybody wants to be in the US market. So anytime the US imposes tariffs, people want to be in our market. So regardless of how high the tariff is, they want to do business here. So it just brings people to the table faster, right? And the media, pick your station. The media is all for the EU and Mexico and Canada and Japan, and Taiwan and Vietnam, China, Brazil, Venezuela. Pick your other country. They're all for those countries using tariffs against the United States, but they're against the United States using tariffs against those same countries. And that only makes sense from the perspective that the people leading the herd want America and the herd itself to fail. So it's a good thing we're not part of the herd. So if if you let's see, we all know what the media is saying, right? It's not like we can ignore it, but that's the advice of like one of my go-to financial people I pay for. Is like ignore the headline. That doesn't really help us. So instead of ignoring the headline, we want to see the headline and then sift the headlines because we can profit off the herd's fears. If we can see where they're being steered, then we can just not follow. So tariffs should not stress you out. Tariffs do not add to inflation. Inflation is going down. And for whatever reason, the Fed's still worried about it, despite studies being done that say there are studies being done. Studies being done looking at whether tariffs raise inflation, and the studies have come back and said tariffs do not raise inflation. And yet the Fed is still worried about tariffs raising inflation, which makes no sense unless it's a power grab and a money grab. And that's really what it is. It's the Fed trying to hold on to power. It's the Fed trying to control the narrative despite the data and the facts. So the media's hype should not phase you. If stocks are down or bonds are down or real estate is down and the herd is panicking, that's a great opportunity to buy. Don't get sucked into the panic, use it. If the Fed is grasping for power and holding on to lower high rates, then there's a bargain to be found somewhere. And I know I still owe you the overall closed end fund strategy. So in lieu of that, because honestly, that's a chunk of information. So in lieu of that, the best advice I can give you consists of three parts. One, learn to think for yourself. Do your own research, build a strategy, adhere to the strategy, tweak it when needed, investigate, learn, sift, look for patterns, read. I won't say read everything because there's a lot of shitty advice out there. You've got to find your trusted sources, and whether they like your strategy or not, you're not necessarily looking for someone who's always going to say, "Hey, that's great. Hey, that like the yes men strategy. That's BS. That doesn't help you." You want somebody who's going to give you consistently good information, and that's dependable. That's actually real information, so that you can then take it and then read it or listen to it, watch it, whatever. You can consume it and then let it sit, and you can sift it and see if it makes sense, and then see how to use that advice to your benefit in whatever strategy system you have, right? You got to search for the deals, whether the market is in the dumps or whether the market, like right now, is soaring. There's a deal to be found if you're willing to find it. You can buy in greed. You can buy in extreme greed. And if you buy, I won't say the wrong stuff, but if you get sucked into that fear of missing out to where you're buying what everybody else is buying, you're going to spend top dollar for something and not get a great deal. Now, like I've said, post dip, so following a dip, I mean, like a year after a dip, you can buy pretty much everything and still come out ahead. But there's a huge difference between coming out ahead $1 in a year, which, and I get this is my example, but it's kind of impractical. There's a difference between coming out ahead, like $1 versus $1,000. You can pay something, you could buy something extremely overpriced, and it's still going to gain versus finding a deal on severe discount that's going to see the same kind of gain, but because it's so discounted and so cheap, you're going to see a much greater gain. So search for the deal, regardless of the time in the market. Find the deals and prioritize the deals. Two, listen to the fear and hype because it'll either tell you the location of the herd or where the herd is going. And then don't get sandbagged by the fear and the hype. Don't buy into it. Don't get sucked into that fear of missing out. Listen to the fear and hype, do your due diligence, go somewhere else. Three, over the past 100 years, the stock market as a whole has returned over 10%. Now, there's a ton of stocks in the stock market. And you know just as well as I do that not every stock is a diamond, right? There's a lot of crap out there. But in the pantheon of stocks, overall, the market has returned 10% consistently. So if you can get better at picking the winners and you can get better at picking funds that are going to pay you and excel regardless of market condition, then you increase your odds of doing well in the market long term. And that's kind of the key here, long term. That 10% growth also does not include dividends. And on the closed end fund side of things, I mean, from my angle, cheaper buy in, greater inbuilt diversification inside a portfolio with consistent monthly dividends that either A, just pay. There are funds that just pay a consistent dividend regardless, which you can argue for, but then you're won't say it's luck because it's not, but if you can find the funds that are increasing their dividends and consistently paying and have the best possible outcome or best possible chance or hope or projection of continuing to increase the dividends, that's just that's cream on top. It's you're you're investing for the long term, hoping and knowing that not every year is going to be amazing, but you're hoping for that 10% gain or greater because you're prioritizing funds. Not every closed-end fund is amazing. Not every general stock is amazing. From my angle, closed-end funds are better than general stocks because they're cheaper, you get better access, you get more access, you get inbuilt diversification, and you get a fat yield. And if you can time it well, which you can't time the market, but if you can do your homework and have the mental fortitude, stomach, however you want to say it, to buy something when no one else is looking at it, which we've done occasionally, you have the possibility of further expanding that gap, of further expanding your wealth acquisition and building. Um, and the herd's biggest issue in the market as a whole is that they are flighty investors. The herd quickly buys in time of greed, and they're late to the party. Any sniff of fear, it's like a pig looking for truffles. but it in the opposite, like as soon as the herd sniffs or sense fear, they sell because they don't want to lose money. That like they're that averse to losing money. So as the market rises and falls, you can't time the rise and fall. So they typically sell early, they typically buy late, and they're always swinging the market. So outside of that, if we can sniff out where they're going or where they are versus where they're going, but also look at the overall trends of the market and of the macro market, world market, we position ourselves in a much, not being redundant, we better position ourselves to be much more successful than the herd just based on investment, but also in strategy. We're not investing in just anything. We're prioritizing what we invest in, and we're also prioritizing the deal. So we're always getting an amazing discount. So when the discount closes, then you can choose what you want to do with it. You can either continue on in the fund or you can sell it. You can swing stuff to where like you're up 20% or maybe you're up 40%. And the market still has room. So you can still hang out and wait. You can add to it. You can dollar cost average, or maybe you can sell your profits and swing it forward into something else. Really just depends on your strategy and also where you see the overall long-term market going. So getting back to my notes and guideline, and I'll briefly review. It's one, think for yourself. Two, listen to the fear and hype and don't get sandbagged by it. Like completely throw out the fear of missing out. And then three, use the fear and hype and scoop an amazing deal. And really, if you want the best deals with the best overall rewards, then you got to play in the closed-end fund sandbox. It's a corner of the playground. And looking at the size and scope of the playground as a whole, it's a small corner of the playground, but you're going to find amazing deals, amazing discounts, fat dividends, fat monthly payers in every sector of the market. You just have to get better at sifting the funds. Or I guess listen to my videos and watch me sift the funds. So even with last week's, I don't know, road texture change, not a blip. I mean, it's down a little bit, but not like hardly a scrape. The CNN Fear and Greed Index is still cruising in the extreme greed range. And that means, I mean, pending strategy, you can sit and wait. You can buy discounted area, or maybe depending on what you own and how the market's doing, you can sell. But from this vantage point, there are still deals to be found if you know where to look. So we're on the forefront of America's golden age and technological revolution. So discounted tech is an option. And if you trace tech back, it's all an oil derivative. So if you can find cheap oil, oil's a great option too. Uh, let's see, real estate is a great option because if you can make profit with a high rate, you can rake with a low rate. And on our end of things, like we have a single investment property that is its own challenge to manage, and everything that goes into it. But what you're looking at is like either a real estate investment trust or other real estate apparatus, and they've got thousands of properties. Real estate investors define them by doors. It's not like a front door, back door, but like a front door. So a single family home is a single door versus a 4-bedroom apartment is a single door, or maybe it's 4 doors based on how many people you have living in the apartment. But real estate companies manage thousands of doors. And if they can profit now with high rates, they can rake with low rates. The other option would be bonds and bonds proxies. So bonds, yes, outright bonds, bonds, municipal bonds, corporate government, whatever you want to pick, but really corporate bonds and municipal bonds. And then CLOs, collateralized loan obligation, or kind of a securitized debt. Um, gosh, you can rake with those now. Then the proxies would be real estate, and then utilities or yeah, utilities. So it gives us a wide selection. I mean, you could say it's diverse, uh, right? Diverse. Yeah, I guess you could say that it's your strategy has options. You can invest into everything. You can target invest into one. It really just kind of comes down to you and where you think the market is, where you think it's going, how much money you have to invest, and how much you're willing to spend. Um, and then overall, regardless of what you buy this week, you just have to realize that not be coughing, but you just have to realize that almost everything is worth more than 1 to 2 weeks ago. Maybe last week is almost like an even shakedown. Almost every fund I updated this week was slightly less than what it was last week, but the market as a whole lost anywhere between a 0.5% to 1%, depending on the market. Um, and I mean, some funds were higher, most were lower. So if we look back 2 weeks, right, almost everything is worth more than it was 2 weeks ago. And it's really only going to escalate the longer we stay above board in greed territory. So the longer we're in greed and the longer people, the herd really, uh, employ the mentality of the fear of missing out and they continue to funnel money into the market, we want prices to inflate, but it also makes it harder if you're looking for a deal. Because I mean, closed-end fund wise, they can be discounted, and there are still some pretty significant discounts. But if it's $2 more than it was a month ago and it's still the same discount, yes, you're still getting a discount, but you're also paying $2 more than it was a month ago. So let's get into this and then apply what we've talked about so far. So this is the shortened list for the week. Uh, I did triples. I guess we can include these, the dollar cost average moves. Uh, and in brevity, I say the same thing every week, but everything that's color coded from here up, so 60 funds currently, everything with some level of asterisk gets updated weekly. The entire spreadsheet gets updated monthly. Uh, we track all of these funds for one reason or another. We own the funds that have these designations. This one is the Roth account. The other is just the cash account. Um, and cash account meaning it's not cash. It's just uh, it's not an it's cash based account. It's not an IRA. It's not a Roth. It's just a stock investment account. And then as I do the debt, so I update price and net asset value each week. I go back and skim through the target descriptions to see where they rank versus single asterisk would be tracking. Double asterisk is a dollar cost average value based on what we already own, hence the dollar cost average. And then three asterisks would be a significant discount. And every single company listed, it's a significant discount based on that company's data. So it's not FCO compared to HFRO, it's all just FCO data. And then I take generally the double asterisk and the triple asterisk, I put them on a different list. And I sort it based on the criteria. So we want monthly payers. The one exception, I mean, the only company we've bought that's not a monthly payer is ADX. For reasons that I'll really get into on that portfolio buy, looking at ADX's, oh, there it is. Looking at ADX's history, which I see I need to update now. Looking at their history, looking at their longevity, looking at their success, and then what they currently have, I couldn't find an argument against it. But since we just bought it, and let's see, our next round of buy would not be until either the last week of July or the first week of August. So we're not buying tomorrow. Um, and I can keep it on the list just because, but the goal is monthly. And I guess I'll get into it. So ADX it's all stocks, and the push lately has been stocks uh, for reasons I've covered on past videos. But if you look at ADX's portfolio, and let's see, as a side along, so the only two straight stock funds we own are these two. NBXG is tech heavy and 5G heavy, and it's not just investment into tech funds like Meta and ASML and IBM and that stuff. It's companies who will profit the most through tech. Versus ADX has some companies that, well, I mean, every company will profit by tech. ADX prioritizes or like hyper focused on tech as well as just solid companies, growing companies in general. Uh, they're between the two, they are. I like it because they're limitedly invested in that. I mean, both countries are both companies are invested in under 100 other funds. Uh, has a chunk invested into oil. So I guess it's everything tech and stock funds, and then they're also invested into a closed-end fund, which is their own closed-end fund about, regarding oil and natural resources. Um, but seeing where we are on the forefront of the tech boom or the next golden age for American technology and America as a whole, both companies are hyper focused on investments in areas that would see the most or have the potential for seeing the most growth. And I couldn't find an argument against it. I mean, I prefer monthly, but there is no offset. I prefer not that much money, but I couldn't find a competitor that had the same track record. Um, so I bought 100 shares of it the last time we bought, and together, I mean, between ADX and NBXG, I like that combination. Um, Other funds I know that typically, or say at least by past history, have just stellar track records. I mean, USA and ASG are all, as far as I recall, all 100% U investment stock investment funds. The difference between those two and these two, USA and ASG are sister companies, uh, or brother companies, I guess, however you want to find it. Um, but USA has an automatic dividend reinvestment plan, which does help buy down your shares. So you get paid a dividend, they automatically reinvest it at whatever the going rate is for the company. Over time, you get more shares. Over time, your overall share price drops, like your overall average share price drops, which is great. And it just continually reinvests. The thing is, I don't like that because I want the cash dividends because I want to invest them where I want to invest them. And if ASG or USA is at a premium, that's not the best deal. Um, so for a good two punch, I like these companies together. Um, so it in current metric, I mean it's close to. So yeah, we'll leave it on the list. So generally it's monthly, but that's going to stay on the list. Um, After that, we look at we look at yield, and it's got to be 9% or above unless there's a good reason for keeping it on the list. And that's going to be both of those because ADX in years past has paid a special dividend or a hidden dividend. We'll see if they keep that up. And then NBXG has paid a consistent dividend since they started. And for a small company, they are competing with the big guys. So that gives me some hope that they will eventually raise the dividend. But these three would stay on the list. They're municipal bonds. They pay tax equivalent dividends. Um, so on face value, it's tax equivalent is generally about 2% higher than what's listed, generally. So they would stay on the list. These two would not. I went into I deep dove Eaton and Calamos last week. I'm not going to do the same thing this week. HFRO pays close to it. They've paid a consistent dividend since they got restructured. Uh, the discount overall has come and go. I still think it's a great buy-in. DLY joins, it's not normally on the list, but their discount has increased. ZTR is a decent dollar cost average. It's just we bought it when we were with Webull, and honestly, the more I look at the portfolio, it should do well. It's just for whatever reason not doing well. Pays a solid dividend, uh, but honestly, it's a roller coaster buy that I've described in weeks past. And given the option, I would rather buy something else. CIF is a roller coaster buy, and the Roth Maggie. Uh, yeah, you can read that as much as I can. So it's close. Just depends on what you want to pay for it. FCO, the price has not been able to go past like 724, I think is the highest it's been. It's kind of the next hurdle for it. The discount has gone down significant or closed, however you want to say that, significantly. I think it does have the opportunity of going premium. That's kind of the thing. We bought it recently. There you go. We paid 720 for it. Um, I mean, we could buy it at where it is now, um, but that goes along with the fear of missing out. Like we could buy it knowing nobody knows anything about the market, I'll put it that way. We could buy it, highly suspecting it's going to go higher and get into premium territory. And it's that general fear that you'll miss the opportunity or the fear of missing out. Um, but on my angle, I've kept to this buy-in timeline, uh, and I'm sticking with that. So it's less of a fear of missing out now, I guess, compared like if no, even then, I've stuck with that timeline. I think I've pushed it back 2 weeks once, um, but it doesn't make me want to buy it now and suspect that this will change to premium. But if it happens, it happens. Let's see. We already own a collateralized loan obligation company, and I don't feel like paying 3 times as much. Let's see. PIMCO has great funds. On my angle of things, so I'm doing this list based on me investing. Um, I'm not telling you what to buy. I'm walking you through how I would go about picking funds for a week, whether we're buying or not. PIMCO is a great bond fund. They have an incredible track record. Their funds perform well. It would be a great pickup for us in the fact that it would add a PIMCO fund to our portfolio, but it doesn't really give us anything different than what we already have. I mean, we already, I mean, of the two, I would say now three well-known bond companies, you've got PIMCO, Double Line, and Saba or the BRW Saba Capital. Um, we already have several bond companies. Adding another one for the sake of adding a PIMCO fund is on it from my angle, just over diversification and not needed. But on your end of things, if you want to consider it, then consider it. From my end of things, I generally delete the funds or take them off the list because I, I am very averse to diversification for diversification's sake, and over diversifying spreads our money out thinner, and it's very hard to grow wealth or grow anything over over money that's been too spread out. River doesn't help us, doesn't give us anything we don't already have. So if I'm going to add a fund, it's got to be, I mean, bare minimum equal to what we already have. And you could make the case for a lot of those, but it's got to be also be better than what we already have. It's got to fill a void or do something that solve a problem in an area we lack, or tackle a problem a different way. And you could argue that all of these companies tackle problems a different way. That's not exactly my point. It's if we look at just what's inside the fund, yes, you get like a portfolio in a can mentality, which is never really my preference. Has a high bond allocation, super, close to 70% in fixed or bond income. But we're already invested in a lot of funds. And honestly, I'm not a huge BlackRock fan, which is one of the reasons why I like BRW is because they weren't a huge, whether they were a huge BlackRock fan or not, they didn't like how BlackRock was treating its shareholders. So instead of complaining about it like everybody else does, they bought a majority share in BlackRock and then have been trying to nominate people to the directors board to change how BlackRock pays out dividends to their shareholders. Um, so I'm not a huge BlackRock fan unless you're changing the company. Highland Global, sister fund of this Highland account, and I loved this fund when it was not a portfolio in a can. And since it's changed the mentality, or they've really spread their investments out, which it's that divert. Do you really need to diversify? That's really the issue here. Now, I'm not saying so. If you look at we own a fund, and we own a fund named RFI. It's a real estate fund. It's if you look at the fund, they are 100% invested in real estate, but they're also invested into a lot of companies that are real estate companies. If you look at the portfolio in a can structure of how Morningstar or CF Connect or pick your overall managing company looks at the stocks in your portfolio, maybe from the company's angle, they're all invested in data and data management. But from Morningstar perspectives, it's technology and defensive and this and that and the other. And without the missive from HGLB, I only see the stuff from Morningstar. So, or NCF Connect for that matter. Um, so when I reviewed their data on Morningstar initially, it was broken into like maybe four sections. And the last time I looked at it, it was like double that. And it's all perception. So maybe it's all still just technology, and the company's investing into where they feel they're investing. Let's say that they're investing into private funds that I don't have access to, that are still all technology based that they feel will grow best with AI and technology. But Morningstar breaks them out differently. Maybe it's not a portfolio in a can, but it looks that way. I just wish I had data from HGLB that says it's not portfolio in a can, it's this, but I haven't seen a missive from them in a while. Maybe I can find it on their website. Maybe I'll look for it this week and see if that tells me anything different than I can find elsewhere online. BRW is bonds like CF investments. They've expanded into crypto and minerals and metals. It's a shareholder activist fund and an activist fund in the sense that they want shareholders to be paid better. So uh, I've been a fan of BRW for a while. And then OXLC I've already mentioned. So of what's still on the board, what would I consider for the week? And it's still pretty much this list. I mean, I would love to find a discount oil company or discounted oil company. I just haven't seen it. I'm not a huge outright consumer fan unless it's just like a tag along inside a different portfolio. But we're still looking at what's in green. So overall, what gives us the best deal? Until I know more, not that. Um, Municipal bonds, I forget if it was last week or 2 weeks ago. Municipal bonds are incredibly boring in the sense of that, like all of them, all of these companies just continue to chug along. Um, their prices fluctuate, which means their yields fluctuate. But if you want just like a, if you want a bond investment that has a super low default rate that's going to pay you pretty consistent dividends and that are tax equivalent dividends, then municipal bonds are a great option. And it's, I mean, quite honestly, if your money market and liquidity these days is still pretty liquid in the sense that you could be invested and then sell it and poof, your money's there. So if you've got a chunk of money invested into a money market and it's paying you 4%, 5% maybe, six, I think I've seen seven, but that makes me question some things right now. We'll say it's paying you 4%, and then suddenly the Fed cuts rates, which is what we want, and maybe your money market fund goes down on interest rate. If you wanted a if you wanted a spot where you could just sock money away and just expect it to grow with little work on your part, then that's a municipal bond fund. And Nuveen runs the largest municipal bond fund. Like when someone's got a bond, pick your municipality. When it's like, hey, we're going to sell bonds, Nuveen scoops the best deals. So uh, on my end of things, honestly, my goal has been to hit $1,000 in those three. Or my goal has been to hit 1,000 shares of those three. Um, so they would stay on my list, and unless their prices just go exponentially higher, right? And they're just not a great deal. The next time we buy, I would anticipate picking up another 100 shares of each. Um, and they're still great buys for this week. But what would I pick? DLY, we already own DSL. So I mean, I would really have to compare portfolios to see if one get like if DLI is, or I would really have to compare if DSL and DLY are that different. If it's really the same thing, then I would rather invest where we already are. Um, ADX would stay on the list simply because of its track record and what they are currently invested in. The 45 cents is an estimate because they changed their structure. It used to be so they pay 4 times a year. So they would pay 5 cents, 5 cents, 5 cents in this hidden special dividend that had 5 cents plus whatever else it was, $2, $3, whatever. So you get this super fat dividend check in December or January, whenever it's issued. But now they've spread it out through the year, and the current promise is to pay out 8% of their NAV, net asset value, 8% of the net asset value at every dividend payment, which I would rather they paid a consistent 45 cents. I mean, because they've paid 47, 46. I don't know what the next one's going to be. I'd rather they paid a consistent 45 cents and then still added that extra at the end of the year and paid a special dividend on top of the 45 cents. But I don't work for the company because at least that way it would be consistent. But what I would really like is for them to take that 45 cents and then spread it out monthly. So you can go 15 cents all year. Still, it's the same thing. I mean, it's the same end annual dividend. Well, this is my estimate based on so far. It's the same overall end dividend. It's just I get monthly income and I love monthly payers. And I get, gosh, I get the dividend policy and it still grates me a little bit, but I couldn't find a counter to it. So I bought it. Um, so I would leave it on the list. HFRO, I still think real estate is a great deal. Meggie would be higher for us, about $1.60 higher for us. And that's kind of what I was talking about. Like you could buy something that's still in decent discount territory, but it's going to cost more. So it probably wouldn't stay on the list because it's going to cost more. Like my goal is always my goal is in a perfect world, right? So everything on here has a historic discount. It's three asterisks outside of the municipal bonds. Um, Everything on the list meets the target focuses for the week. But if I really got my wish list of things, then the current price would be less than what we already have as an average. So VRW is 811, and I guess I am showing our portfolio. It's higher than what we currently have. ADX is the same way. FCO is the same way. HFRO is different. See, not much different, but different. HGLB is higher. Maggie's higher. The municipal bonds fluctuate. So the municipal bonds, I believe, are all lower. Nothing else is on the list. So OXLC ought to be lower. Yeah, OXLC is lower. So if we look at it from that angle and take off the stuff that's higher than where we bought it or higher than our average, we end up with this list. Three municipal bonds, real estate, and then collateralized loan obligations. Um, and this is where diversification and the desire to invest everywhere kills you because you can't invest everywhere. Like so if that's what you have to invest, $1,000 gets eaten up pretty fast. Um, I'm doing what I normally do. Like I think I've bought 200 in OXLC every time we've bought it. BRW has been 100 to 200. I think maybe 300 the first time we invested. Generally, every time I invest in BRW, I buy FCO right now because they're both in discount. HFRO, we could pick up. ADX, oops, ADX, yeah, we just bought 100 spot. But if you do the math, oh, look, it's under 10 grand. Um, and your dividend a period is off because that doesn't pay every month. So you're still getting a decent overall annual, better than 9% yield overall. It's just the one thing really throws it off. And in the extreme perfect world, this would pay monthly. Um, so that being said, Oxford Lane, if we prioritize and thin this out into what's lower, that's $20 higher than it was the last time, just by streamlining our investment. And that's really, I mean, the ease of this worksheet of how it's or spreadsheet of how it's been set up is why I did it this way. I wanted a cost that I could then multiply to get a final amount. Um, how the dividends are structured, the overall yields are like I didn't find this online. I made it and I tailored it to my needs. So we could invest in everything and actually get a smaller dividend. And we're prioritizing. So we factored out ADX because it doesn't pay monthly. So we could streamline or focus, limit the diversification. We actually get a better overall dividend by streamlining our investments, at least on my end of things, of streamlining and investing into things that we already own that are currently cheaper than our current buy and price average. So that'll probably be my and yeah, if I'm going to hyper focus on what we're investing in, it would be these. It would be these five. If you've got more leeway, there we go. It would be this. Is it six, seven? Nope. Yeah, nine. It would be the nine. But same thing. Like you're going to spread 10 grand over nine funds. That really does limit how you're going to invest that 10 grand. So I think these would be the top options. And then it's really how you use them and how they break down. You've got the options for municipal bonds, technology and 5G, real estate, corporate bonds, private lender, which is why I just love this fund of how it's set up inside the fund, BRW, which is the shareholder activist fund, and then yes, it's taxable loans, but it's really the collateralized loan. It's the CLOs. Um, and I mean, OXLC doesn't hit discount that often, but when it does, it's worth a look. So this would be my final list for the week. And then how you break it down really depends on you, your strategy, and your needs and your portfolio. So let's see. Reminders. If you like my content, consider subscribing to the channel. Hit the like button on the video and then really help me get the word out that there's a better way to invest than the traditional single stock purchase that doesn't pay a dividend. And then help me help other people by liking the videos, subscribing, and then commenting on a video. And really, if you want to comment about stocks, what you own, what I buy, why I did this, like anything, just ask. And then if you want to find me day to day, best way is to comment on a video. I am, um, when I do still manage those pages on Facebook, but since I've been looking for a different hosting platform, I'm honestly not on those pages that often. I'll get the notification for them, but I'm also not on the pages that often. Biggest thing for the week is to figure out what your strategy is and then how best to implement it. I mean, we're in times of greed. I don't really see that changing anytime soon. There's deals to be had. Just depends on how it impacts you, your strategy, and your overall portfolio. So happy hunting. Um, if you're buying this week, happy hunting. Good luck finding the deals. Hopefully this video helps. And let's see what else. That's really about it. I mean, who knows what the news holds for the week, or who knows what the week holds for the news, pending your perspective. Um, gosh, and on my end of things, summer's coming to a close. We've been slogging through a lot of financial updates, and I know I've still got more information to share with you and more information that I owe you. So I will work on that and attempt to make some progress in other areas. And if you have questions, by all means ask. So hope you have a great week, and I will see y'all on a different video. Bye-bye.